Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Ben Slavin, Global Head of ETFs and Asset Servicing at BNY, Gavin Filmore, Chief Revenue Officer of Tidal Financial Group, and we have Anita Rausch, Global Head of ETF Capital Markets at Alliance Bernstein. We're here to discuss the growth trajectory of ETFs, the product pipeline, and institutional usage. It is great to have all of you with us. Welcome to Trade Talks. Ben, I think it's pretty safe to say that 2024 was an active year for ETFs, and there's somewhat of a pun in there.
Without a doubt, and first, thanks for having me back as well. I think 2024 was certainly the year of records, and by every metric on the dashboard, that's exactly what we saw. Record assets, record product, record flow. We saw an individual ETF set its all-time active record, and certainly for active ETFs, again, a record, right? We saw product launches, but both assets, I think close to 300 billion came into active ETFs as a whole, which was shattering the all-time record. But also in terms of flow, obviously passive bigger, but certainly actively managed ETFs were capturing investor attention. 6% of AUM in the industry, roughly, but close to 26% of the flow. So if you think about it, really almost 4 times its weight in terms of that organic growth rate compared to passive, but got a lot of room to grow ahead of it.
Why do you think there's the rise of active ETFs, Gavin? I'm surprised that the numbers are actually as low as they are, considering the environment in 2024.
Yeah, I mean, I think it all begins with pushing for innovation. The wrapper itself is obviously on the forefront of innovation. It has been for decades. For anybody that's looking to enter the market, they want to find white space. They want to be different. They know a Me Too product isn't necessarily going to capture assets. And I think some have learned that the hard way. So now, with rule changes and more adoption at the forefront, everybody's looking to say, okay, this active thing is definitely here to stay, right? I think if you go back 3-5 years ago, it was maybe a question mark. The ship has sailed. Everybody is comfortable with active ETFs. The market has proven that. And if you're looking to crack into the market, like we see every day in our business, it's a good place to start. It's not always the right answer, but it's definitely a good place to start the conversation.
Yeah, and Anita, what areas are you seeing the growth in active ETFs? Is it because the market's been so dynamic and there's new thematics emerging? What verticals is the growth in?
To be quite honest, the growth we see personally all across the board, just because there is so much white space. I think the time is active. You know, it took a long time to active to come to the table in the ETF wrapper. Like you said, Gavin, because of the rule change, the barrier to entry came down a couple of years ago. The active ETF managers and all of, actually, to be quite honest, the other types of asset managers are like, okay, you know what, it's easier for me to get into active ETFs. Let's see how we can play in this field. And then we all started to realize that it was the ETF wrapper that the clients really want. And it wasn't a passive versus active discussion or question mark that we all thought over the past 10 to 15 years, right? Since, I don't know, for the past 15 years, we've seen the graphs of passive ETFs grow, active mutual funds decline, right? And the initial inference was, oh, they want passive, they don't want active. But quite honestly, I think what the numbers from last year, the record-breaking numbers across the board, in active especially, are showing is that it's not active versus passive, it's the ETF wrapper. And just to tack on to your numbers, Ben, the record, 8% or 6 to 8% of the industry is the active ETFs, 25 to 30% of the flows last year, but 75% of the launches, right? So the active ETFs are really firmly on the runway and filling that white space that's out there.
Yeah, and that's a good distinction that Anita makes, Ben, because of the benefits that ETFs offer. I think because of the demand of some of the underlying, it's important to understand what's within that wrapper too.
Of course, I mean, that's been kind of the mantra in many ways of ETFs, know what you own, and you really need to look under the hood. And honestly, that applies whether it's an actively managed strategy, of course, but also whether it's passive. And there's a lot of indexes that have obviously different ways to weight stocks, and your return profile and risk profile is completely different. But generally speaking, I think when you look at these products, whether it be different types of indexes and certainly more recently active, I think all great points and agree with all that was made. But I would also add that as the market gets more comfortable with these products, sure, but many of these products also, especially in the active space, have started to gain their 3-year plus track record as these products have started to come into the market, where advisors and investors can really evaluate real-time track records. Also the fact that not all, but many of these products have begun to scale, also giving not only retail investors, but even some institutions more comfort that the pool of assets is larger, and that in and of itself helps to attract more assets and also allow for platforms to put these products on the shelf for investors to access.
Right, and Gavin, that's why we're seeing the growth in derivatives, ETFs as well. Why is that attractive to whether it's retail or advisors leveraging them?
I think in a sense it's an extension of the same story with respect to active, right? So we've got the same reality that people are searching to be innovative with product, pushing the boundaries into derivatives as part of it. We talked about rules before, right? So 6011 was this opening of gates for active management, but then you had 18F4, which is the derivative rule, which has really leveled the playing field there as well. And then Jill, I think you were also suggesting that market conditions do have something to do with this as well. So obviously, we've actually been in a pretty strong market, but we've had some deep, dark declines, right? Obviously, like COVID as an example. So you've got a lot of innovation with respect to buffers and protections. Others are looking for leverage or income, and to do those products, you have to have derivatives at the end of the day. And these are really solving a problem for the end user and investor, right? To build portfolios that are not as simple as a 60-40, kind of just long stance only.
Now, it's also more expensive if you try to replicate those strategies on your own as well, and then manage them. Anita, one of the big themes last year was fixed income, and it certainly did play out. Can you give us some insight into that and why the preference has shifted?
Well, I think just the environment, right? Shifting interest rates, volatility, geopolitical uncertainty. We saw, our personal suite actually saw a tick up in fixed income assets for sure, but I think overall, fixed income, one, in ETFs makes sense because they're providing a layer of transparency, price discovery, and an extra layer of liquidity on an over-the-counter market, right? And then, but also, sometimes I think active actually makes more sense in fixed income because of the numerous types of CUSIPs and that exist in the bond world, and then you need a little bit more flexibility. And so it was sort of the perfect storm with the active ETFs coming to market, the market environment, where fixed income ETFs sort of had its day.
Yeah, well, I mean, you noted here, Yukon Endowment, they shifted to ETFs as a preferred vehicle, cheaper risk management, as we were discussing before, and the liquidity profile is a little bit different.
Well, right. I mean, they sold their hedge funds to use buffer ETFs for downside risk management. They're capping upside. But I think the takeaway here from my standpoint, is that they're using ETFs for all the benefits that we've touted ETFs for the past 20, 30 years, right? They're more efficient, they can possibly be cheaper, and in this case they are. They're more tax efficient, and they provide an extra layer of liquidity.
Yeah. Ben, what about share classes? That's not widely discussed as much. Why is that a hot topic in the industry right now?
Yes, certainly. This is something that our clients are discussing quite a bit, and we've engaged really across the board with a number of different managers who are either have filed publicly or are considering issuing a share class, an ETF share class off their mutual fund. And part of it was what Anita referenced earlier, which was just this structural decline of mutual funds and this growing preference for consuming investment content in an ETF wrapper, and ultimately share classes are one way to do it. However, all of this is still pending with the SEC, and as we've seen more interest publicly in those managers looking to get into it, there's a lot of questions in terms of how this would actually work, ultimately the disclosure and regulation, and honestly just the timing. I think also the industry needs to come together here as well to look at solutioning across multiple platforms to be able for the platforms ultimately to be able to automate and do this at scale, because our expectation is that there will be a lot of interest as this becomes available in the market.
As an investor, as it relates to ETF share classes, does it make that much of a difference in a portfolio, or what are the nuances that the industry is advocating for?
Yeah, it's a long list.
Right.
I would say ultimately from an investor standpoint, this has been sort of well traveled in the market. So certainly Vanguard has been in the market with a multi-share class product for many years, and honestly, it is quite common in other parts of the world, except for the US, to have multi-share classes. So from a BNY perspective, we've been servicing these products for quite a long time. And the shareholder experience for the ETF shareholder, the expectation is will look, smell, and feel like an ETF and have basically all the same characteristics that they like: liquidity, transparency, and the like. It's just ultimately getting the regulatory side straightened out, and ultimately being able to have the operating models in mass to be able to support this across the market.
Gavin, I want to switch gears for a moment here and talk about alternative strategies, as there certainly is a lot of demand from retail all the way up to institutional and family offices and so forth. So what are some of the nuances you want to watch for with alternatives within an ETF wrapper, number one? Number two, what about when you start leveraging some of these strategies?
Yeah, sure. So I think it's very cool to see this innovation curve within the ETF industry sort of take shape and arguably maybe even accelerate over the last 5 years, right? So we talked about active, we talked about derivatives. Alts, sometimes can be synonymous with derivatives, but they don't always have to be. On our platform, right, we've seen long-short strategies, CTAs, leveraged funds, income-focused funds, and the like really come to market en masse, and quite frankly, actually take more market share and attention from sort of more vanilla strategies. Right. At the end of the day, it's providing people access to things that can be very helpful for their portfolio, and really taking what was maybe reserved for super institutional pension funds, whatever, and bringing it to the masses. And that's a good thing, especially when there's good education around it and when the wrapper can support it. And we've seen a lot of acceleration with respect to, if you view ETFs as almost a technology itself, you see all the market participants stepping up to be able to support them as well, right? And we certainly see that at the exchanges. We see that at the market makers, right? The number of market makers that can support derivative-based strategies have absolutely exploded over the last few years.
Right, and in particular, if you want to get some sort of an edge on a strategy, I mean, 60-40 can only take you so far when you're expected to deliver differentiated returns, but we were talking about this off camera, understanding the profiles of what's underneath those ETF wrappers, especially as it relates to alternatives, because some of them don't have the same liquidity profiles as a stock index.
Right. Yeah, no, you definitely need to know what you're buying, but Gavin, to your point, I mean, ETFs provide or democratize access to everything, but you do have to be selective and understand what it is that you're getting into.
So when you think about 2025, and the market's always climbing a wall of worry, and there's always some element of uncertainty out there, how do you expect the ETF market to perform in terms of growth and new product introduction?
Well, I think that's the great thing about the wrapper or the technology, right? I personally think it's going to perform great no matter what happens, because it's going to provide that solution for whatever the market throws at us, right? If there's political uncertainty or volatility, the use of ETFs actually go up during periods of volatility. If certain sectors of the market, interest rates shift in different ways that people didn't expect, ETFs are going to be there as a quick access vehicle. And I think that's the whole point of ETFs, right? It's the accessibility. It fits into how a lot of our investors want to consume our thinking and the asset management that we put out, right? A lot of the advisors are using models these days, and that's why all of us want to put a lot of our best thinking in the ETF wrapper to make it easy to consume and more efficient to consume.
Yeah, and I would imagine, Gavin, digital assets is going to be a big part of the story for 2025.
Yeah, and I mean, of course, that was probably the story of the year of 2024, and I probably said that lightly. I think it's no doubt the story of the year. And again, you see a lot of issuers that are looking at that space and saying, okay, what else can I do? And you're seeing product either filed or come to market around that space. It's just one example. Right. There's many more, but we certainly see a lot of inbound interest there. But it won't be the only story. I think it'll remain an important story in 2025, but we'll be surprised tomorrow too. Something new will catch our attention.
Well, Ben, it's interesting, the spot Bitcoin ETF, certainly that was a catalyst. But once you get that regulatory framework executed around that, and then I mean, can you imagine what that'll do for a product?
Well, certainly, there's a lot of interest, and I agree. It was the story of the year, and something to certainly watch into this year. But I would say the theme, and it goes back to what you were saying earlier, is that this theme of innovation and the flexibility of the ETF wrapper. This is no longer synonymous with just passive investment. I mean, the flexibility here and the innovation that the industry has put behind ETFs has been nothing short of incredible. And Jill, you were mentioning earlier about what might happen in 2025. I mean, what I can say is that the industry doesn't seem to have a shortage of ideas in terms of how to put product out there for pretty much every market scenario that you can think of, or at least put tools out there that investors can use, whether it be to hedge or tap into these other spaces of the market, which would certainly include digital assets for sure, and especially the issuers has their full attention given the success that we had in 2024. We'll see what happens, but certainly that's a hot space to continue to watch.
Ben, do mutual funds go away? Or do you expect to see more convergence, I guess is a more appropriate question?
No, I mean, there's a long runway here. The trend line is obviously clear, right? I think, certainly there's a lot of different drivers here in the market that will either accelerate or could accelerate that. Certainly another market drawdown, in every market cycle where money has come out of the market, ETFs have picked up market share and taken another stair step up. When that happens, I have no idea, but it is, based on all of the prior periods when that's happened, ETFs have, again, gained even further against mutual funds, but also some of these other things that we were talking about, certainly with regard to share classes, and as other managers look to convert mutual funds straight away into ETFs, again, which we've seen over the last couple of years. Again, just more assets and more market share being stolen from mutual funds by the ETF wrapper.
Yeah, so what I'm hearing is continued growth certainly in derivatives, themes, and alternatives.
Yeah, and one thing to add maybe to the mutual fund story is mutual fund conversions get a lot of attention, but SMA conversions are arguably easier decision to make.
High level detail, explain more.
Yeah, so the mutual fund conversions can be quite tricky because there's a lot of risk of cannibalization of business, how you're engaging with platforms where those mutual funds may be already approved, versus SMA strategies, separately managed accounts, where the tax efficiency alone, it sort of becomes a no-brainer, and the operational ease for the manager to run those strategies in the ETF are very, very favorable. So I would say actually just, at Tidal's business, we see those conversations move along a bit faster at least than the mutual fund conversation.
Yeah, which is interesting. And Anita, last word here, when you think about continued trends in 2025 and how you see institutions continuing to adopt these strategies.
Well, I think I'm obviously talking my own book here and my own lens. Active ETFs can continue to rise because I think they're just at the beginning. There's a lot of white space in the active ETF world, which is usually not the case in the past couple of years in ETFs, right? A lot of the different corners of investment strategies have been filled by different types of ETFs. But as far as institutions, right, it takes a while for institutions to can and want to use the ETFs, especially in the active world. Sometimes you need a 3-year track record, which we're sort of coming up upon the first batch, or just past the first batch of ETFs, 3-year track record. You need size, scope. And so I think there comes a tipping point in acceleration of growth in active ETFs by all platforms, advisors, retail, but institutions as well. And I think we're going to come up upon that tipping point this year.
That's interesting. Ben, I saw you wanting to jump in. Last 30 seconds.
Always love to get the last word. I would just say, look, I mean, certainly we are seeing the exact same trends, and from our lens, we have a purview really across the industry. And I think certainly maybe the way to wrap this up is just to say we see growth coming from literally everywhere, right? Conversions, SMAs, agree, mutual funds, but also organic product. And we didn't talk, even new issuers continue to come into this market. So, really we see the growth coming from sort of all these various spots, and all, sort of leading to what we expect to be another kind of fruitful 2025 for sure.
All right, appreciate the insight, everyone. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.